Welcome to today's session on financial literacy and economics. By the end of this video, you will be able to distinguish between nominal and real interest rates and use the Fisher equation to calculate how inflation impacts your purchasing power. When you look at a bank's website or a credit card statement, the number you see is the nominal interest rate. However, to understand if you are actually gaining or losing wealth, you need to look at the real interest rate. Let's break down why these two numbers are so different and why that difference matters to your wallet. Let's start by defining our terms. The nominal interest rate is the interest rate as it is usually quoted. It is the percentage increase in the number of dollars you have. The real interest rate, on the other hand, is the interest rate adjusted for inflation. It represents the percentage increase in your actual purchasing power, meaning how many more goods and services you can actually buy. Think of it this way. The nominal rate tells you how much more paper money you have, while the real rate tells you how much more stuff you can get with that money. If prices are rising because of inflation, your money doesn't go as far. So even if your bank account balance is growing, you might not actually be getting richer in terms of what you can afford.
To connect these two concepts, we use a fundamental tool in economics called the Fisher equation. In this formula, R represents the real interest rate. I represents the nominal interest rate, which is the rate the bank gives you. And the Greek letter pi represents the inflation rate. Essentially, the real interest rate is what remains after you subtract the effect of rising prices from your nominal gains. Let's walk through a step-by-step example to see how this works in the real world. Imagine you put $1,000 into a savings account. The bank offers a nominal interest rate of 5%. At the end of 1 year, the bank adds 5% to your balance. You now have $1,050. This is your nominal gain. However, during that same year, let's say the inflation rate was 3%. This means that a basket of goods that cost $1,000 at the start of the year now costs $1,030. To find your true gain, we use the Fisher equation. We subtract inflation from the nominal rate. R equals 5% minus 3%, which means R equals 2%. Your real interest rate is only 2%. Even though your bank balance went up by 5%, your ability to buy things only increased by 2% because prices went up while your money was sitting there.
Now, let's look at a scenario that surprises many people: a negative real interest rate. This happens when inflation is higher than the interest you are earning. Suppose you have a bond that pays you a nominal interest rate of 2%. At the same time, the economy is experiencing high inflation at 6%. Using our formula, 2% minus 6% gives us a real interest rate of negative 4%. In this case, even though you are technically earning interest and your total number of dollars is increasing, you are actually losing purchasing power. Every year, you can buy 4% less with your savings than you could the year before. This is why investors are so concerned about inflation. It acts like a hidden tax on your savings, eroding the real value of your money. It is also important to consider this from the perspective of a borrower, like someone taking out a student loan or a mortgage. If you take out a loan with a nominal interest rate of 7%, that is the percentage of interest you pay to the bank. However, if inflation is 4%, the real cost of your debt is lower than it appears. The real interest rate is only 3%. This happens because you are paying back the loan with cheaper dollars that are worth less than the ones you originally borrowed. As a general rule of thumb, when inflation is unexpectedly high, borrowers benefit because the real value of their debt decreases, while savers are hurt because the real value of their wealth shrinks. To wrap up, let's review the core objectives we covered today. We learned that the nominal rate is the face value increase in dollars, while the real rate is the increase in what you can actually buy. We applied the Fisher equation to see how inflation acts as a subtractor from your nominal returns. We saw that high inflation can lead to negative real interest rates, which erode savings but can actually make debt easier to pay back in real terms. Next time you see an interest rate advertised, take a moment to think about the current inflation rate. calculating the real interest rate will give you a much clearer picture of your financial health. Thank you for joining this lesson, and happy calculating.